Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So, we got to talk about the FOMC meeting that we had yesterday, came out yesterday. And I'm going to summarize some comments from Powell, which basically ignited the stock market rally that we saw yesterday and that we're seeing currently right now this morning. Now, here's the thing, just to summarize all of it. The markets wanted to see if, especially from the dot plot and the forecast expectations, are we going to see a change in 3 rate cuts? That was the big deal. After seeing the data, are we going to see maybe Powell change his mind, saying, maybe 2 rate cuts instead of 3? But as soon as the statement came out with the projections and everything, it stayed the same, meaning that the Fed is still thinking about cutting in total 75 basis points this year. So doing 3 rate cuts. And that's what caused the markets to basically get riled up and where you saw this massive rally, mainly because they're still sticking to their views of 3 rate cuts. Now, with those 3 rate cuts in mind, the markets are now pricing in that the first rate cut could come in summer, which is June. And there's about currently a 70% probability that that could happen. Now, with that in mind, we could see, those still change depending on the data. But it looks like that's not the case. And it looks like, from what Powell has said, that they're going to continue to stay on the 3 rate cuts and continue to be dovish, as they were in yesterday's meeting. Now, they did mention next year, that even though they're doing 3 rate cuts this year, next year, lesser chance of rate cuts, and mention that rates, even though if we cut rates, they still may remain high for a long time. So that means that if they do 75, or even if they do 100 basis points of rate cuts, let's say they bring it down to around handle, then you could expect, some sort of you know pause in those rate cuts, and leaving those rates higher for longer to still create that tightness in the market. And their reason behind that was the the growth in the job market and the strength and the resilience in the economy. So that was the main key, the main point. Now, um, what's interesting also is that it makes you think that with elections coming up the end of this year, is Powell getting pressured from the government to do these rate cuts? Because we did hear from Biden also basically say, in one of his speeches, that we could expect soon some good amount of rate cuts to come in. So it makes you think that definitely there might be some pressure there that is causing this to causing the Fed to do rate cuts this year and then maybe not cut that much next year, right? So things can get really, really political, especially during the election time. Now, remember, the path of how rate cuts happen after tightening so much, and especially with everything we've been talking about, recession. Um, the path tends to be that when they start cutting rates and they're on the rate cut cycle, they don't cut aggressively, they start slow. And it's possible that they could pause, according to Bostic, what he said before. Um, but then when they go back to cutting rates again, whether it's next year or the year after, When they go back to cutting rates again, especially if after some pause after their initial rate cuts, you could expect that you might get maybe faster rate cuts. And when that happens, it tends to be because the economy is going through some turbulence. So this is just the beginning, and that's why we see here the equity markets do quite well. We're seeing it pick up quite nicely, and we're seeing the strength and resilience since the FOMC, and we've been seeing the equity markets continue to push up higher and higher. Now, I'm going to go over some few comments from the Fed, basically on strength and stability. So, what he mentions about strength and stability, saying that the strong job market, is not a reason for us to be concerned about inflation. Saying that, hey, even though there might be strong growth, don't worry because that's not going to feed into inflation. That's quite dovish that he said that, saying that we could be cutting even if the economy is still strong. Strong hiring all by itself would be a reason to hold off, would not be a reason to hold off on rate cuts. So even saying that, even though we get strong payrolls number, doesn't mean that we don't have to cut rates. Those two lines alone are just telling you he's setting up the pathway that rate cuts are going to happen this year, and markets feel that it's likely going to happen in June, right? So he's setting it up, telling you that all the strong hiring doesn't mean that we're not going to um, hold off on rate cuts. We are gonna cut rates, right? Now, is it because he's pressured politically, or is it because he sees that something is about to break, right? That we will know in the months and in a year from now. Strong hiring by itself would not be a reason to hold off on rate cuts, like I mentioned. On labor market, if we're getting a lot of supply and demand, you could potentially have bigger economy where inflation pressures are not increasing. So basically explaining the soft landing scenario there. Labor market is in a good shape. Things uh, are returning more to a pre-pandemic state. Wage growth moderating to more sustainable levels. We are seeing strong labor market. Extreme imbalances mostly resolved. Don't see cracks in the job market. Don't see cracks in the labor market. Jobs are good. Jobs are good. Jobs are good. And we're still going to cut even if jobs are good. That's the whole summary on strength and stability there. Now, what he says is that we are closely watching layoffs after saying that job market is strong. And he does says that initial claims are very, very low. Now, here's the thing that many people don't tell you. In history, when initial claims and the unemployment rate and the jobless numbers are at historic low levels, or forget about historic, but are very low levels, we tend to see an uptick afterwards, which tends to then result to a recession. All right. So what's weird is like we don't see any cracks in the labor market, but we're watching layoffs closely. I mean, very contradicting to say that, right? It's like I I'm not going to take the bus today, but I'm going to sit in front of the window just in case it comes. Or let me put it in another analogy. I'm not going to have ice cream today, but I'm going to sit in front of the window and wait and just see if the ice cream truck comes. Just just watching it closely. That's all. But I'm not going to have ice cream. Then why are you at the window watching and waiting for the ice cream truck? Right? How tempted would you be to run out, give your money to the ice cream guy and get some ice cream? Right? So same thing. You don't see cracks in the job market, but you're closely watching the layoffs. Well, it is one of the, you might argue it's one of their mandates, right? Employment, it's got to be strong and resilient. They got to make sure people are employed and inflation is low. But then you just told us it's fine. So why do you got to watch it very closely? So again, very contradicting there. Um, Very weird when it comes to the comments that he said initially and then what he said afterwards, right? And then he comments about inflation concerns. It is very important that we get inflation sustainably down. We need to take time to assess if recent inflation represents more than bumps in the road. Saying, again, a little bit worried about the inflation and saying that it needs to come down, worried about those bumps if, those bumps ends up being something else, ends up, seeing a roar in inflation. Recent inflation data has an altered story of inflation coming down to 2% on sometimes bumpy path. Inflation data came in a little bit higher than expected. So a little bit concerned there about inflation, but still cutting rates. Don't worry, they're still cutting rates, but still worried about inflation and still worried and watching, not worried, but watching the jobless numbers carefully, watching the layoffs carefully. We made no decisions about future meetings today. We will depend on data dependent again. We heard that before. We are strongly committed to bringing inflation down to 2% over time. Nevertheless, we continue to make good progress on bringing inflation down. We will make decisions meeting by meeting. We will carefully assess incoming data to decide policies. So, still data dependent. We'll tell you meeting by meeting what they think. We need greater confidence in inflation moving sustainably down before we cut rates. They need to see more data, is what they're saying. Likely to cut rates at some point this year. But don't worry, we're going to cut rates this year. So I'm giving you my assurance because elections are coming. Our policy rate is likely at its peak. We're not hiking. We are not going to overreact to these 2 months of data nor ignore them. Kind of balanced comment there, but still they're cutting rates, so not to worry. Will limit risk to money market volatility. Slowing pace of runoff will ensure smooth transition, mitigating chance of money market stress. General sense is to slow pace of runoff fairly soon. Our general sense is we will start to run off fairly soon. On balance sheet, we discuss issues related to slowing the pace of decline in the holdings. Discuss balance sheet at this meeting. So even talking about the balance sheet there, right? Saying slowly pace of runoff will ensure smooth transition. General sense is to slow the pace of the runoff. So basically, slowly QT eventually, right? After cutting rates for some time, QT will eventually end, right? Do you guys remember what comes after QT? QE, right? But it doesn't happen that fast until there is drastic problems in the economy, right? But first, you gotta get those rate cuts coming in. They can still do QT, but slow it down. Eventually, they will stop the QT, and then you could expect maybe QE. Um, our long run goal is to return to balance sheet that is mostly treasuries. We are going to pay a lot of attention to the past mistakes on the balance sheet runoff. In going slower on balance sheet, we think we can get further. It will mean we run much less risk on liquidity issues. Now, mentions about interest rates and the economic health. Powell goes on to say it is still likely in most people's view that uh, we will we will have rate cuts this year, but dependent on data. Okay, so they're going to cut rates, but if data, shows that inflation is going to skyrocket, then they're not. Which is weird again, right? Because like you initially came out saying that jobs are strong, this is strong, that is strong, we're still going to cut rates. What are you saying now? But there is tremendous uncertainty around that. My instincts is rates won't go back down to very low levels we saw before. So even though they cut rates, like I said, let's say bring it down to 5 to the 4% handle, um, they're not gonna cut it down all the way to zero like before, especially if we're still in soft landing, right? Economy's still fine. Don't expect that to happen very soon. Um, Thus, why you might think that, this year might be a little bit political, right? If you still want to create tightening and the economy is still fine, why are you cutting rates? Leave it where it is. It's doing its job. Why are you so concerned about cutting rates? Again, is it politics? Instinct is that we already covered that. Don't think we know that rates will be higher in the longer. Don't think we know that rates will be higher in the longer. But longer run, we will expect that rates will come down, because longer run, some shit's gonna hit the fan, and and things gonna get worse off, right? Bring down to 5 to 4%. Elections happen. Commercial real estate talk is what everyone's talking about, and then bada bing, bada boom. Next year, end of this year, if those commercial real estate properties, they got to refinance. A lot of people got to refinance. If those start trickling into more banks get affected. You get the idea. They've got to cut rates. They got to do QE. Jobless numbers, layoffs, like he said, watching it closely, skyrockets, then there's a problem. So overall, let's summarize here. Great for equities, great for bonds. Everything went up to the moon. Assets like crypto, gold, etc., skyrocketing. Powell just igniting the stock market rally even further. Again, is it politics? Is it something that, they see coming down the pipeline in the future? Time will tell. We'll see what happens. But for now, this is positive for the equity markets, for the meme stocks, for the crypto stocks, for gold, for many assets out there, and even bonds. Um, but as we get more rate cuts further and further, we'll see bonds ignite even more aggressively. But until then, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.